Hey guys, in today's video, we'll be going over chapter 13 of the Builder's Guide to Accounting. If you guys have any questions, please text the number above. And if you guys want to join the WhatsApp group, please message that number as well. If you guys are interested in joining the course, the link is down below. I teach you guys everything you guys need to know for the Builder's Guide to Accounting to pass the exam. I also go over the math you need to know for the exam. So yeah, I hope you guys like today's video. Let's get into it. Now we're getting into chapter 13, equipment records. The largest single investment that most builders make is for equipment. You list your equipment on your balance sheet at its cost and depreciate it over its estimated life. The act of setting up an asset in the general ledger is called capitalizing. To take expense for a purchase over the life of an asset is to depreciate it. Fixed assets aren't actually fixed, so the term long-term asset is often used. This is more accurate because it describes an asset with a long, useful life. Long-term asset, let's explain what a long-term asset, and then a current asset as well. Current asset is less than 1 year. Long-term asset is over 1 year. Make sure you know that. Okay. The well-organized builder should have a defined plan for fixed assets. Classifying fixed assets, your balance sheet should show enough details to reveal the true position of your business. And then right here, of what most builders should use to classify their fixed assets: office furniture and equipment, trucks and autos, machinery and equipment, small tools, building improvements, land. This is very important. All long-term assets except land are depreciated. Right there, very important. Unit cost for equipment. This requires certain information about each piece of equipment, estimated average hours of use and idle time. And then it has more over here. This information will help you put together more accurate estimates and analyze project cost. All right, figure 13. 4, under distribution by jobs, record the amount of idle and repair time and useful activity. Depreciation, super important here. Depreciation is designed to let businesses recover the cost of buildings and equipment over the useful life of the property. And then they're going over the Marks Act right here. Very important, read through that. Modified accelerated cost recovery system. You need to know what the Marks is. Okay, how to claim depreciation. There are several ways to claim depreciation. Under Marks rules, you may use a prescribed method or elect to use one of several straight line alternatives. But assets you begin depreciating under the rules can continue under the old method until depreciation or recovery has been completed. Questions you must ask before you begin to depreciate assets. Is the asset depreciable? You can't claim depreciation on land, inventory, or intangible property. Very important. And the Mark system dictates the depreciation periods you're allowed to use for each specific class of asset. The depreciation periods, called recovery periods, specify the time over which you can claim depreciation for that class of asset. We'll go over that. Straight line depreciation is a way to spread the cost of an asset evenly over its useful life. The same amount of depreciation is taken each year until the depreciable base is reduced to 0. This is very, very important. You need to know how to do straight line depreciation. It's one of the most important math problems on the exam. Right here, they're showing an example. I go over this in the course, step by step, how to do straight line depreciation. And also, they will have questions on the test about straight line depreciation that they don't talk about in the book. I go over them in my course so you know everything and you're well prepared for straight line depreciation. Declining balance depreciation. So this I go over in my course as well. You need to know how to do straight line depreciation and also declining balance depreciation. The most important one is straight line depreciation. You can probably pass the exam without learning declining balance depreciation, but we'll go over it real quick. To calculate declining balance depreciation, the first step is to calculate the straight line depreciation, ignoring any salvage value. So this is how you get it right here. You do straight line depreciation first. And then there are several percentages used with declining balance depreciation: 125%, 150%, or 200%. and then you do this one, and then right here for the next year's depreciation, you will do this ratio right here. Once again, I go over all this in my course. Link down below to join the course. Okay, and I just wanted to show right here, if you look here at figure 13.9, it's showing you the difference. So on the test, they might ask you on year 3 under straight line depreciation or under declining balance depreciation, who had the biggest depreciation. So if you see on the 3rd year, it looks like straight line had a bigger depreciation than 150% of declining balance and 125% of declining balance, because you have to remember straight line has the same amount of depreciation each year. Declining balance has a different rate of depreciation each year. And right here where they were talking about the mark rules right here, the depreciation period called recovery periods specify the time over which you can claim depreciation for that class of asset. And it goes right under here, class lives under Mark's rules, and this is very important. You will probably see this on the test, so make sure to put a tab there or highlight this. You will probably see this on the test. I'm pretty sure I had the question right here for residential real property, including rental manufactured housing. Over what class do you depreciate it over? And it's 27.5 year class right there. And then right here, light trucks is 5 years, office furniture is 7 years. So they'll ask you like, under what class do you depreciate office furniture under the Marks rule? And it's 7-year class right there. Straight line is required for residential and non-residential real estate, but not for most other classes. Very important right there. You can make another important election to expense property placed into service in a year. That means you write off a lump sum instead of taking the deduction over a number of years. To qualify, you have to meet a few rules, and then here's the rules right there. Amortization, that's what I was talking about. Amortization spreads the cost of a major expense over time. Lease or buy, benefits if you lease. They might ask you a question like, why is it better to lease than to buy? And the most important thing right here is an immediate tax deduction is available for the cost of monthly leases. So you have an immediate tax deduction if you lease equipment. Read through this, it's super important. Under a lease purchase agreement, the full value of the equipment is included as an asset, and the full liability less equity is listed as payable, both currently and in the long term. Depreciation on the equipment can begin immediately as well. Sales and trade-ins. When equipment is sold, the books have to be cleared of all entries relating to that asset. Super important. The other part of this entry is to book the gain or loss on the asset. These aren't operating gains or losses, and they have to be kept separate from regular sales and gross profit. Otherwise, your comparison of operating results will be distorted. If a piece of $2,500 equipment depreciated to $7,000 is sold for $4,000, the loss in the sale is $3,000. Super important. Learn how to do this as well. I go over this in my course. So that is going to be it for chapter 13. If you have any questions, please put it in the comment section down below, or you can text my WhatsApp number as well. And if you guys want to join the course, the link is down below as well.